Every time you query ChatGPT, you're consuming silver. Every AI image generated, every autonomous vehicle decision, every machine learning model trained. They all require infrastructure that depends on one element, the most conductive metal on Earth. And the people building this revolution? They haven't calculated what happens when that element runs out. Right now, at this precise moment, the artificial intelligence industry is creating the largest industrial commodity demand shock in modern history. And almost nobody is connecting the dots. The technology that's supposed to reshape civilization, that's attracting hundreds of billions in investment capital, has a physical dependency that current global supply chains cannot satisfy at scale. This isn't theoretical. This isn't distant future speculation. Data centers are being constructed right now that will consume more silver annually than entire industries. AI chip production is ramping at exponential rates. Training runs for frontier models are demanding computational infrastructure that would have seemed impossible 5 years ago. And every single component in that infrastructure, every advanced processor, every high-performance server, every precision cooling system, requires silver in quantities the market hasn't priced into any forecast. Here's what makes this particularly dangerous. Investors are obsessed with AI equity exposure. They're bidding up semiconductor stocks, cloud providers, and software companies. Analyst reports debate which models will dominate. Venture capital floods into AI startups. The entire financial apparatus is fixated on the digital layer. Almost nobody is examining the physical commodity bottleneck building underneath the entire technological stack. That bottleneck is silver, and it's tightening faster than the market realizes. Let's descend into why AI specifically demands silver at scales previous technologies never approached. Silver possesses the highest electrical conductivity of any element on the periodic table, superior to copper, superior to gold. In applications where signal integrity, minimal resistance, and thermal management are non-negotiable, there is no substitute. AI processing doesn't happen on standard consumer chips. It requires specialized GPUs and custom AI accelerators, power-dense, heat-intensive, precision-engineered components operating at the absolute edge of materials science. Every AI chip contains silver across multiple critical layers, conductive traces that carry signals at nanosecond speeds, bond wires connecting die to package, thermal interface materials managing heat flux, and switch contacts that must survive millions of cycles without degradation. The more advanced the chip architecture, the more silver per unit. Now scale that single chip to millions operating simultaneously across thousands of data centers spanning every continent. Then add the server infrastructure itself. Each rack requires silver-bearing connectors rated for high current loads, busbars distributing power across multiple systems, contactors that must handle repeated switching without failure. Then layer in the cooling systems. AI data centers generate extraordinary thermal output, heat densities that would cripple conventional facilities. Cooling at this scale requires industrial compressors, specialized heat exchangers, and precision thermal management systems, all dependent on silver-bearing components for reliability under continuous extreme stress. Then add the electrical distribution architecture. These facilities consume megawatts relentlessly, 24 hours daily. Power distribution at that magnitude requires silver-plated contactors and switchgear to minimize energy loss and prevent catastrophic equipment failure. But here's where the demand curve becomes exponential rather than linear. AI technology isn't maturing and stabilizing. It's accelerating. Every new model generation demands more computational resources than its predecessor. GPT-4 required vastly more training compute than GPT-3. GPT-5, whenever it arrives, will demand even more. The next breakthrough beyond that will require more still. And every company racing toward artificial general intelligence is locked in a computational arms race where competitive advantage flows directly from scale. More parameters, more training data, more compute, more infrastructure, more silver. This isn't like smartphone adoption, where technology eventually matured and replacement cycles stabilized. This is relentless escalation where each breakthrough requires constructing entirely new layers of physical infrastructure. Now layer in the second-order effects that amplify this demand profile. AI doesn't exist in isolation. It's the enabling technology for multiple other sectors, each of which carries its own silver intensity. Autonomous vehicles require AI processors for real-time decision-making, but they also demand silver in electric motors, battery management systems, sensor arrays, and high-voltage charging infrastructure. Smart grid modernization depends on AI for load optimization and predictive maintenance, but the physical grid requires silver in switchgear, transformers, and distributed IoT sensors monitoring every node. Advanced manufacturing integrates AI for process control and quality assurance, but the robotics executing those processes need silver-bearing contacts, precision actuators, and high-reliability electrical systems. You're witnessing a reinforcing feedback loop. AI accelerates deployment of technologies that themselves require substantial silver, which creates additional demand for AI infrastructure to manage those increasingly complex systems. And all of this is happening simultaneously with the largest energy infrastructure transformation in human history. Global solar installations are expanding exponentially to meet renewable energy commitments. Each photovoltaic panel consumes approximately 1/3 of an ounce of silver. Projected solar capacity is set to triple by decade's end. Electric vehicle production is ramping under regulatory mandates across major economies. Each EV requires roughly 1 ounce of silver. Annual production volumes are expected to increase from 10 million units to over 40 million within 5 years. 5G network infrastructure is proliferating to support the Internet of Things. Each base station contains silver. Millions of new stations are being deployed globally. The industrial demand isn't emerging from a single sector. It's converging from 5 or 6 massive industries simultaneously, all enabled by the same technological revolution, all competing for the same finite element. And silver mining production? Essentially unchanged. This supply-demand imbalance has instructive historical precedents. In the 1960s, the United States government faced an analogous dilemma with silver. Industrial consumption was accelerating, but silver coins remained in monetary circulation, creating competing demand streams for a finite resource. As industrial applications expanded, the Treasury's strategic silver stockpile began draining at alarming rates. By 1965, it became mathematically clear the government could not simultaneously maintain silver coinage and satisfy industrial requirements. They made a choice: abandon silver in currency entirely. The U.S. transitioned to copper-nickel-clad coinage, removing billions of ounces from monetary circulation to redirect supply toward industrial use. But even that massive supply injection proved insufficient. By 1970, Treasury silver reserves approached exhaustion. The government ceased silver sales completely. That crisis unfolded during a period of incremental industrial growth. We're now entering an era of exponential industrial demand acceleration. There's another parallel from the copper market worth examining closely. In 2006, copper prices spiked to unprecedented levels as China's rapid industrialization created demand that exceeded global production capacity. Mining companies rushed to expand output, but new copper mines require approximately 10 years from discovery through production. The supply response lagged dramatically. During that multi-year gap, copper prices remained severely elevated, triggering cascading cost increases across every industry dependent on copper: construction, electronics, power transmission, transportation. Eventually, new capacity came online and markets rebalanced. but the adjustment period generated significant economic disruption and inflation. Silver faces an identical lag dynamic, but with a critical additional constraint. Silver is predominantly a byproduct of other mining operations: zinc, lead, copper, gold. You cannot simply mine more silver by opening dedicated silver mines, because economically viable primary silver deposits are exceptionally rare. Increasing silver output requires massively expanding base metal mining operations. But base metal demand is also surging due to global electrification. You're competing for the same capital investment across multiple commodity sectors simultaneously. The supply response will be even slower and more constrained than copper's decade-long adjustment. Here's why this trajectory may reach a structural breaking point. AI development has become existential for nations and corporations. It's no longer viewed as competitive advantage. It's perceived as survival. Countries that fall behind in artificial intelligence risk economic irrelevance and strategic vulnerability. That means investment in AI infrastructure will continue regardless of input costs. Companies will pay whatever is necessary to secure chips, servers, data center capacity, and operational resources. But silver is a microscopic market compared to the capital flooding into AI. Total global silver production is worth approximately $30 billion annually. The AI industry is attracting hundreds of billions in investment every year. If AI infrastructure begins bidding aggressively for silver supply, they possess the financial capacity to outbid virtually every other sector except perhaps defense and critical national security applications. When that dynamic emerges, you'll witness bifurcation in the silver market. Tier 1 buyers, major AI corporations, defense contractors, critical infrastructure operators will secure long-term supply through premium-priced contracts that lock in availability. Tier 2 buyers, smaller manufacturers, consumer electronics producers, jewelry fabricators, will face persistent shortages, price volatility, and allocation rationing. This pattern already exists in other critical materials. When semiconductor manufacturers locked up rare earth element supplies through long-term contracts, smaller industrial users found themselves priced out of markets or facing unpredictable availability. Silver appears positioned to follow an identical trajectory. There's also an escalating geopolitical dimension that creates a potential point of no return. China dominates global rare earth processing and has strategically wielded that dominance as geopolitical leverage. The United States and European Union are desperately attempting to construct domestic supply chains for critical materials to reduce strategic dependency. Silver now appears on critical materials lists for multiple governments. If nations begin stockpiling silver for strategic security reasons, separate from commercial demand, that permanently removes supply from civilian markets. Once governments start accumulating for national security, market fundamentals transform entirely. You're no longer analyzing supply and demand. You're analyzing strategic competition. So what does this mean for your economic reality? First, understand that AI-driven silver demand will likely manifest as broad-based cost increases across the consumer economy. Silver is embedded in countless products you interact with daily: smartphones, household appliances, vehicles, medical devices, computing equipment. As silver prices rise due to AI infrastructure demand, those cost increases propagate through supply chains and ultimately reach consumers. You'll pay more for electronics, automobiles, and any product containing electrical components. This is commodity-driven inflation, harder to control than monetary inflation, because it reflects genuine physical scarcity rather than policy choices. Second, if you maintain positions in technology equities, you should recognize that component availability constraints could limit growth regardless of demand. We've already witnessed how semiconductor shortages disrupted entire industries during the pandemic recovery. A sustained silver shortage would create similar bottlenecks across multiple sectors. AI companies might possess unlimited capital and world-class engineering talent, but still face deployment delays because they cannot source critical physical components at required scale. That supply risk isn't currently reflected in technology sector valuations. Third, if you're considering wealth preservation strategies, commodities facing structural deficits represent fundamentally different risk-return profiles than financial assets. Financial assets depend on institutional stability, functioning credit systems, and sustained market confidence. Physical commodities depend on geological availability and extraction capacity. When demand structurally exceeds supply across multiple years, prices must adjust upward until either demand is destroyed or new supply emerges. There's no central bank that can expand silver supply through policy decisions. That scarcity dynamic holds value in an era of unlimited monetary expansion. So what are sophisticated capital allocators doing with this information? Some are establishing positions in primary silver mining companies and royalty firms, businesses that benefit from sustained elevated prices without bearing full operational risk. Others are accumulating physical silver directly, treating it as a hedge against the commodity inflation that AI-driven demand will likely generate across the broader economy. There's also been substantial capital flowing into silver recycling and urban mining technologies. If primary supply cannot meet demand, recovering silver from electronic waste and end-of-life products becomes economically attractive at higher price points. Investment funds specializing in battery recycling, electronics reclamation, and advanced material recovery have raised billions in capital. They're positioning for a future where extracting silver from discarded products generates higher returns than mining virgin ore. Then observe the strategic institutional buyers, sovereign wealth funds, national investment entities, and multi-generational family offices managing dynastic capital. These institutions aren't trading silver volatility. They're making long-duration allocations based on the thesis that industrial demand will structurally exceed supply for years or potentially decades. They're not seeking quarterly gains. They're positioning for a multi-year demand supercycle driven by irreversible technological transformation. There's a reason these accumulations happen quietly, without public announcements. If AI-driven silver demand becomes a widely recognized investment thesis, prices would front-run the actual physical shortage by months or years. Sophisticated capital accumulates before the narrative becomes consensus. Let's map what the next 3 to 5 years might bring. AI model training continues scaling exponentially. Each successive frontier model requires 10 times the computational resources of its predecessor. Global data center construction accelerates dramatically. Simultaneously, solar installations maintain aggressive growth trajectories to meet international renewable energy commitments. EV production ramps to satisfy emissions regulations. 5G networks expand to support proliferating IoT infrastructure. All of these trends are already locked in. Government policies are set. Corporate commitments are public. Infrastructure plans are approved and funded. The demand is arriving regardless of commodity prices. On the supply side, new silver mines won't achieve commercial production until the late 2020s at earliest. Current mining output is barely growing despite higher prices. Recycling helps at the margin, but cannot close a structural deficit measured in hundreds of millions of ounces. That means the market runs an expanding deficit every year. Above ground, inventories deplete. Vault stockpiles diminish. Industrial users compete for constrained spot availability. At some inflection point, perhaps 2026, perhaps 2028, a major industrial buyer faces a critical allocation problem. They cannot source sufficient silver to meet production schedules. They begin bidding up prices aggressively to secure necessary supply. Other buyers observe prices rising and panic order to lock in inventory before costs escalate further. That behavior creates a self-reinforcing feedback loop. Prices spike rapidly. Smaller manufacturers get priced out entirely. Production curtailments ripple across industries dependent on silver availability. Governments face a stark choice: allow market mechanisms to ration supply through price, or intervene with export restrictions and mandatory allocation systems. Either path generates substantial economic disruption. Here's the element that should genuinely concern you. The technology sector has constructed its entire AI development roadmap on an implicit assumption of infinite physical scalability. More sophisticated models, more parameters, more computational infrastructure, more data centers. They've executed sophisticated engineering analysis. They've modeled electrical power requirements meticulously. They've calculated semiconductor production needs across multiple generations. But has anyone actually modeled the cumulative materials demand across the entire technology stack at projected scale? Has anyone calculated total silver requirements if the AI industry scales the way every major forecast assumes it will? And if those calculations exist, why aren't they being discussed publicly? Two interpretations are possible. Either the comprehensive materials analysis hasn't been conducted, which would represent a staggering oversight given the capital being deployed and the strategic importance being assigned to AI leadership. Or the analysis has been completed, and the results are sufficiently concerning that publicizing them would trigger the exact commodity price spiral they're trying to avoid while quietly securing long-term supply. Consider the incentive architecture. If you're a major technology corporation building AI infrastructure at scale, the last thing you want is a public narrative driving silver prices higher before you've locked in multi-year supply contracts at current prices. You want to quietly negotiate sourcing agreements while silver remains relatively cheap. You want to stockpile critical components before markets recognize there's a structural shortage developing. And you definitely don't want retail investors and commodity trading firms front-running your procurement operations. Silence serves your interests. Transparency works against you. The people who understand the AI silver dependency most deeply have the strongest incentives to say nothing publicly. So how should you process this strategically? First, recognize that commodity exposure serves entirely different functions than equity exposure in portfolio construction. Technology stocks provide leveraged exposure to earnings growth and innovation. Physical commodities provide exposure to geological scarcity and extraction constraints. In an AI-dominated economy, both allocations can be strategically valuable, but they hedge fundamentally different risk vectors. If you believe AI will reshape global economic structures, owning AI-related equities makes strategic sense. But if you also recognize that AI has physical dependencies that could become binding constraints, commodity exposure provides important balance. Second, consider time horizon carefully. Commodity supply cycles unfold across years or decades, not quarters. A silver shortage won't materialize overnight. It builds gradually as annual deficits compound. That dynamic favors patient capital allocation, but can frustrate short-term traders facing volatility without immediate price confirmation. Third, evaluate counterparty risk within your commodity exposure. If you want silver exposure specifically because of physical scarcity concerns, paper proxies may not serve that function adequately during actual shortages. We've observed this dynamic in other commodity markets. When palladium faced severe supply constraints, the spread between paper futures prices and physical delivery premiums exploded. Investors holding paper contracts didn't benefit from the physical scarcity premium. If your investment thesis centers on industrial shortage, physical exposure aligns better structurally with that thesis. Fourth, monitor AI infrastructure developments continuously. Data center construction announcements, semiconductor fab expansions, and frontier model training breakthroughs all carry direct implications for silver demand. Commodity markets might not react immediately to these developments, but physical consumption flows respond to actual infrastructure deployment. The AI revolution is real, The technology will fundamentally transform industries, economies, and societies in ways we're only beginning to comprehend. But every revolution requires resources, and this particular revolution requires silver, the most conductive element on Earth, at scales the global supply chain was never designed to deliver. Every frontier model trained, every data center constructed, every autonomous system deployed, they all consume physical materials that cannot be created by software, synthesized by algorithms, or printed by central banks. The AI boom has a silver problem, and the people racing to build the future are about to discover that physics doesn't negotiate with venture capital. You can't mine silver with market capitalization. The models can grow infinitely complex. The algorithms can become infinitely sophisticated, but the metal they depend on, that's finite, and it's already running out.